One of the important reasons why cash flow from operation differs from the net income or the profit after tax is working capital. So, in these three slides, starting from now, I'm going to explain to you how working capital affects the cash flow from operations. Working capital, of course, has no effect on net income itself. Now, as you can see in this illustration, we have uh, the number of units here. So, we are considering the example of a simple company, which is a trading company. It buys and sells stuff. So, at the beginning of year one, let's call it the start of business, the company bought 100 units of its products. During the year, it sold 60 units. So, the cost of goods sold relate to just those 60 units. Okay, so as you can see, the price per unit was $10, and then the company managed to sell each unit for about $15. So we are following the principle of matching here. The cost of goods sold are matched against the sales, and you have a profit of $300. Now, the data about collection and payment is independent, of course, of the sales and cost of goods sold. So let's say out of the $900 of sales, 450 was collected by the end of that year, and the payment was for $500. So 1,000 was due to suppliers for the purchase, but only 500 was paid. So the cash flow is minus 50. Now you can see that the profit is different from the cash flow from operations. Right here, the profit, of course, has been calculated without considering a host of other expenses such as salaries, taxes, interest, and so on. But this simplification does not take away from the main message. Now, the difference between the profit and the cash flow is $50. Now, this the difference between the profit and cash flow is $350. And why does this happen? And this we will see is being explained by the working capital. So at the end of the period, you have $400 of inventory left. How did we get that? We bought $1,000 of goods, sold 600 of it, so 400 is left as inventories. The account receivable is $450, which is actually the sales minus the collection during that year. And then you have an account payable, and this is due to suppliers. So you bought goods worth $1,000 and you paid only 500, so 500 remains as account payable. So we come up with a number called working capital. So what exactly is working capital? It is current assets minus current liabilities. In this case, the two current assets are inventory and account receivable, and the current liability is account payable. And so we get a working capital of 350. Now, I call this the change in working capital simply because this is year one, and at the beginning of year one, the company had no working capital at all. So if you see here, the difference between the profit and cash flow is explained by the amount that is locked up in working capital. So that means more the current assets, higher will be the working capital, more the current liabilities, other things remaining the same, of course, less will be the working capital. So we now move to the next slide. In this slide, you can now see us moving to year two. And, in year two, what goes on is that we have made some more purchases. And of course, in year two, we managed to sell 80 units, and therefore the profit relates to 80 units. And here is the profit figure, 400. And the collection and payment data has been obtained independently. And it turns out that we collected 600, paid 700, and so the cash flow is minus 100. So the difference between the profit and cash flow in the second year is $500. Right now, here the inventory figure computation requires a bit of adjustment. Remember that we had $400 of inventory at the beginning of year two, and then we added to that another $1,200 of inventory. So we have 1,600. Right, the opening inventory plus the purchases during the year. Out of this, we sold 800, and so the balance left of inventory is 800. Now, a similar adjustment need to be made to the account receivable. You start with what was there at the beginning of year two, which is basically end of year one, and then you add to that the sales, which is 1,200. So there is 1,650 to be collected from the customers, of which 600 has been collected and 1,050 is left behind to be collected, and therefore the account receivable at the end of year two is 1,050. So you do the same for account payable and you come up with a working capital figure of 850, which represents a $500 working capital increase compared to the working capital at the end of year one. So we say that the working capital has increased by $500, and whenever there is an increase in working capital, it will bring down the cash flows, and that's why the cash flows are much less than the profit itself. So by now, you are probably convinced that cash flow is not the same as profits, and one of the reasons why this happens is the working capital. Now, year three follows a similar pattern of calculation to year two, and you can see that in year three, the working capital has increased further, and the change in working capital between the beginning and end of year three is $450, and that's exactly the difference between the cash flow and the profit. Now, in all of this, you can see that the cash flows that we have been determining have been based on the collection and payment. But very often we don't know exactly how much is the collection and payment, and therefore an alternative way to getting to this cash flow is start with the profit, right, and ask yourself what happened to the working capital. Let's say you start with a profit of 450 and you see that the working capital has increased by 450, then the cash flow will be less than the working capital by that amount. So it'll be 450 minus 450. Likewise, you see at the end of the second year, the profit was 400, but the working capital had increased by 500, and therefore you do 400 minus 500, then you get minus 100, right? So you need not know the collection and payment in order to find out what the cash from operation is. You just need to know the profit and the change in working capital. Now, of course, if there is an increase in working capital, the cash flow is going to be less than the profit. But if there is a decrease in working capital, then cash flow can be more than the profit. And remember that when we refer to cash flow here, we are talking only about the cash flow from operations.